Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, December 17th, 2024. As always, we'll start with the executive summary from today's leadoff warning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio, you need to be a client of 42 Macro. So today's key macro question is, what do the latest hard data signal about the outlook for the U.S. economy? Our answers are the November retail sales data were highly supportive of our resilient U.S. economy theme. The November industrial production data were unsupportive of our resilient U.S. economy theme. Recall that our empirical deep dive study of the U.S. business cycle confirms that these time series are persistent leading indicators of the business cycle, which means they lead on the way up and on the way down. The latest retail sales and auto sales data suggests a no landing is the most likely U.S. economic outcome over the medium term. The latest industrial production and capacity utilization data suggests a soft landing is the most likely U.S. economic outcome over the medium term. Given the relative share of consuming things versus producing things in the U.S. economy, we believe this divergence nets out in favor of the no landing scenario being the most probable. Our Triple S's theme will have something to say about that as we learn more about the size, sequence, and scope of President Trump's policy implementation over the medium term. Transition to our 42 Macro dashboard is here. As always, we'll wrap up with a question from our client. This one's regarding TGA spin down. Says, hi, Darius. I noticed that risk assets performed much differently during the 2021 TGA spin down than they did during the 2022 TGA spin down. Considering this is a feature you have mentioned for Q1, I was wondering if you thought it worthwhile to dig into the nuance of the differences, or if you think that would be wasted effort. So it's certainly not wasted effort. I think it's a fantastic conversation. Let me just take it to the chart to kind of explain, the key takeaways of what I'm trying to convey. So the conclusion is the 2022 TGA spin down coincided with a significant acceleration, significant increase in the Fed's reverse repo facility balance, which ultimately caused net liquidity to decline. You can see this here, TGA spin down here in 2022, significant increase in the RRP balance. And the net result of that was that we had actually declining U.S. liquidity throughout most of 2022. The periods that we're highlighting in terms of the comparable periods we're highlighting with respect to our bullish forecast for the TGA spin down in Q1 of 2025 coincide with the debt ceiling impasse that we achieved back in 2021 and the debt ceiling impasse that we hit back in 2023. We saw $805 billion of TGA spin down during the 2021 debt ceiling impasse. We saw roughly $560 billion of TGA spin down during the 2023 debt ceiling impasse. And obviously both of those contributed to raging bull markets in risk assets. So it's our belief that you're probably not going to see a significant increase in the RRP in Q1 of next year during the likely TGA spin down in that time frame, assuming they don't punt on the debt ceiling moratorium deadline. If they maintain the January 1st deadline, then we're probably going to see the TGA start to get spent down, as the Treasury will be without borrowing authority until they legislated a change. And recall that you need 60 votes in the Senate to enact a debt ceiling increase. And so, it's very unlikely that Democrats are going to just, go quietly into the night and just allow the Republican Party to get what they want. They got to use the debt ceiling to negotiate, whatever their policy priorities are in the upcoming reconciliation budget. So investors need to be aware of that. And so going back to the RRP, recall that we had the Fed was hiking interest rates at the fastest pace in 40 years in the RRP. So what happened was the investors were fleeing money out of duration sensitive assets, both in the stock and bond markets, primarily in the bond market, and putting that money in money market funds. We also saw a significant outflow of capital from the bank deposits as well into money market funds in that time period as well. And so in our opinion, in the context of the Fed having this asymmetrically dovish reaction function at the current juncture and likely continuing to lower the policy rate at the bare minimum, just guide to a much lower neutral rate than they're currently at today, in our opinion, we don't think there's a significant risk of a dramatic increase in the RRP balance in Q1 to offset what is likely to be a significant decrease in the TGA balance. So we're wrapping up there. Darius here presenting our macro minute for Tuesday, December 17th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.